Welcome to Finbot Insights. Today, we are dissecting a peculiar and powerful shift that's redefining the investment landscape. A great rotation of capital has begun, steering money away from the speculative dreams of technology and anchoring it back into the tangible, physical world. This single sentence perfectly captures the almost surreal shift that has defined the start of 2026. You see, the narrative that dominated markets for years has been abruptly rewritten. Understanding this plot twist is absolutely essential for navigating what comes next. To really grasp what's happening, you have to understand the two opposing forces now at war for your capital. On one side, you have the promise of speculative technology, AI hype, and sky-high valuations. And on the other, the tangible reality of physical commodities and everyday necessities. This is the core conflict defining today's market. Now, to appreciate the sheer magnitude of this change, let's set the scene. We need to go back and examine the market conditions at the end of 2025. It was a period defined by chaos, yet one where technology stocks remain the undisputed champions. The year 2025 was, to put it mildly, chaotic. It kicked off with major policy shocks, like the unexpected Liberation Day tariffs that sent markets into a nosedive. What followed was a precarious rebound, one built on consumer spending even as a massive AI-fueled bubble was inflating. But by the year's end, the so-called Magnificent Seven tech giants, the very engines of the market, began to show serious signs of fatigue.
On the surface, the headline numbers looked pretty stable. An 18.5% gain in the S&P 500 seems fantastic, right? But a closer inspection revealed deep structural weaknesses. This gain was masking underlying issues, like rising consumer anxiety and a job market that was clearly starting to cool off. It hinted that the foundation of the rally was nowhere near as solid as it appeared.
And then, in the first few weeks of 2026, the narrative completely broke. The market's preference flipped decisively and without warning. A great rotation of capital began, with investors fleeing the leaders of 2025 and pouring into long-neglected sectors of the economy.
So where's the proof? Well, the first piece of evidence is right here, in the materials sector. It was driven by global supply crunches and a renewed demand for physical goods. Stocks in this area surged, posting a formidable gain of over 9% in just the opening weeks of the year.
This flight to safety also swept into consumer staples. We're talking about the companies providing everyday necessities. These defensive assets saw a nearly 6% increase as investors began prioritizing the predictable, reliable profits of businesses selling things people need no matter what the economy is doing. And in stark contrast, the former market leader, technology, simply faltered. Amid waning enthusiasm for the whole AI story and a string of disappointing earnings reports, the sector actually posted a slight loss. This signaled a profound and perhaps lasting shift in investor sentiment.
Let's dig a little deeper and examine precisely which assets benefited from this dramatic outflow from technology. The winners were not the innovators or the disruptors, but rather the producers of tangible, real-world goods.
Commodities, especially precious metals and energy, became the prime destination for capital seeking that tangible value. Gold prices were bolstered by massive central bank purchases, and the energy sector rallied on very strong demand projections. It was a clear signal that in this new environment, real things matter more than digital promises.
At the same time, investors sought refuge in the unglamorous but incredibly predictable profitability of consumer staples companies. These businesses provide defensive strength because demand for their products is inelastic. People always need them. Suddenly, a company like Procter & Gamble paying out billions in dividends becomes far more attractive than a tech firm with no clear path to profitability.
Now, as a rational investor, you have to ask what fundamental factors drove such a significant and rapid rotation. This wasn't some random fluctuation. It was a logical response to a confluence of powerful economic and psychological forces.
The explanation isn't a single event, but a convergence of four distinct forces. First, AI fatigue finally set in, as years of hype simply outpaced actual revenue. Second, economic realities like persistent inflation made defensive assets far more appealing. Third, investor psychology itself shifted from wild speculation to a flight to quality. And finally, global capital began to diversify away from its overconcentration in United States technology.
So, having solved the mystery of the Great Rotation, we now look forward to what the remainder of the year might hold. The consensus suggests the bull market will continue, but its character has fundamentally changed.
The consensus outlook projects further gains for the broader market, with most analysts targeting an S&P 500 somewhere between 7,600 and 7,800. This implies a respectable 9 to 14% upside from here, but the path to get there will likely be very different from last year. Make no mistake, this bull market will be played by a new set of rules. Strong earnings growth should provide support, but leadership will continue to rotate between sectors. Significant risks certainly remain, but the underlying health of the market actually appears to be improving, with broader participation beyond just a handful of tech giants.
And this leaves every one of us with the final, crucial question to consider in the current environment. In an era defined by shocking plot twists, is the most boring asset actually the smartest bet?
Before we conclude, a crucial reminder. This analysis is for informational purposes only. It does not constitute financial advice. You should not trust me, and you should not trust any other influencer. Always conduct your own thorough research and consult with a qualified professional before making any investment decisions. If you found this breakdown valuable, you can support the channel by clicking the like button and subscribing to Finbot Insights. We'll continue to bring you more sharp, data-driven market analysis. Thank you for watching.